Hello everyone and welcome to the latest edition of the Sharesify podcast. I'm joined as usual by my friends and colleagues Ian Conway and James Crux. Hello gents.
Hello Steve. Hey, you're a skier. How are you enjoying the Winter Olympics?
It's not been so bad. The curling's been particularly good.
Yeah, but fourth, mate. Fourth. So near but yet so far, eh?
Indeed. We've had an awful lot going on this week. Sticking with sport for a second, Thomas Frank has been sacked finally at Spurs. Now, the reason why I say this is relevant is because James and Ian are both West Ham fans, so it does bring to mind me as the only Spurs fan, that Steelers Wheels classic stuck in the middle with you, because I've got clowns to the left of me and jokers to my right.
Very harsh.
That is harsh.
James, you've been looking at some interesting companies this week so far. What have you been looking at?
A couple of small caps caught my eye. They're both in interesting upgrade cycles. So we've got Ramsdens. It's not to be confused with Harry, the old fish and chip shops.
Yeah.
Ramsdens pawnbrokers and jewellery retail. Yet another upgrade to profit guidance on the back of this elevated gold price. So it's the gold buying segment that's ahead, where they kind of, they sell the non-retail pieces to bullion dealers. And that's a sustained cycle of upgrades, and they're also expanding the store estate across the UK in quite a nice way. So that's one to keep an eye on. And then over in the consumer goods space, we get PZ Cussons, which is upgraded guidance and outlined a new sort of renewed growth strategy that's gone down well with the market, which kind of lays down the gauntlet for Unilever up tomorrow, which is now the biggest position in Finsbury Growth Income after that sell-off in AI perceived threat stocks that we talked about last week.
Yeah. And sticking with that, Ian was talking a bit earlier about Elliott Partners taking a stake in London Stock Exchange Group, and we were discussing here, weren't we, about how it seemed a bit odd that they'd been sold down so heavily in this sort of software sell-off. When they're data providers, and I think you said that they actually provide their data to Anthropic and Claude.
They did. They said they signed a deal with Anthropic to supply all this data to Claude, and Claude then turned around and said, well, Anthropic's turned around and said, we can now automate a lot of the processes, and as well as data, London Stock Exchange makes quite a lot of money out of back-end processing and that kind of stuff. So, yeah, I mean, the stocks totally derated in the last 12 months.
Yeah. And
just interestingly, on that cyclically adjusted PE model, it's gone from the top one standard deviation above to one standard deviation below. So Elliott Partners, this is a good time. This is the best time for them to be taking a stake in this business. It hasn't been this valuation since 2012, 2013.
You're perceiving this move as a discount opportunity to get into a quality stock at a discount price. You're not perceiving it as a big stake build towards a takeover.
No, not at all. No, they're activists. Well, Paul Singer set this business up donkeys years ago, and he's they're big activists. They've been active in BP. Yeah. Pushing for higher returns at BP, and funnily enough, did we not mention BP last week on this very podcast and say that they probably cut back their share buybacks because of the weak oil price and the debt? Well, guess what happened this week? They suspended their buybacks, so have Total announced today they're cutting buybacks. I mean, BP used to spend $6.5 billion a year on share buybacks. So it has over the last 5 years.
Yeah.
So it's just not sustainable, and they've got to invest. They've got a lot of new stuff coming on the stream. They need to invest in it. Interestingly, SHEL holding out. They've announced a $3.5 billion buyback for Q1, but I suspect it's a matter of time before they too end up either cutting or suspending the buyback.
Yeah.
No,
just to return to the LSE. I mean, one of the big complaints over recent years has been the data business versus the stock market operation. There have been some fund managers who have called for them to split those two business parts and effectively list them separately, or sell the stock market business, because that doesn't seem to be really generating huge returns. Do you think that might be part of the Elliott playbook?
It might well be, actually, Steve. Yes, you're right, because I think that business is now less than 10% of the group revenues and earnings. So, in fact, the London Stock Exchange Group is a bit of a misnomer, because that's just such a small part of the business now. So that might well be what Elliott has in mind, to be honest.
Yeah. So I mean, a rebrand to Refinitiv, the data business it bought a few years back, I suppose, and then split out the stock market business, and it kind of loses a lot of that those hang-ups that investors occasionally get about the lack of IPOs, and we've had a real dearth of IPOs in the UK in recent years, certainly big ones. And it's really not going to be a serious part of the LSE business model going forward. So we perhaps get a new management team to run that part of the business, and perhaps they'll do a better job at getting IPOs on the London market.
Well, hey, if Elliott Partners are watching, there you go. You heard it here.
Indeed. What else have you been looking at, James?
Obviously, we had the Finsbury Growth Income fact sheet out yesterday. Another poor month for Nick in January, which has continued to February, so that didn't really come as a surprise. But he says he still sees credible opportunity for these holdings to, they bring their AI services to customers, AI enhanced services. So, he's kind of sticking to his guns on those, but we'll see what happens. What do you reckon, Ian?
Yeah, I think it's at a, what do investors do with that? It's at a post-pandemic low. Do you stick? Do you twist? Do you, if you get out now, you're probably losing money. Do you want to crystallise that loss? It's very tough, but to be fair, investors had the chance. If they didn't like what he was doing, they could have voted against it at the continuation vote in January, and something like 95% elected to continue with the strategy. So,
I mean, I suppose that at the end of the day, for retail investors anyway, I mean, the easiest option, if you're no longer a fan of the philosophy or the performance, is you sell your stock and you reinvest elsewhere.
I guess so. I mean, the other thing that struck me this week is we were looking forward to the house builders. We had the Halifax house price index end of last week. That seemed an uptick. First time the average house price hit 300,000 in the UK. So I think people were quite excited. And then Bellway on Monday was okay. They said they saw a decent spring selling season, but oh my word, today Barrett's was down 7%, Gleeson down 10%. I mean, it's too early for these. I've said it before, say it again, it's too early. They're all saying spring selling season is crucial, so they're kind of maintaining guidance at the moment, but it's too early for people to jump in, and that's just shown it. Today's results have just shown that.
Yeah, sure. I mean, it's been busy over in the US as well. They had some very strong tech-related results. Cloudflare, the big cybersecurity, network security company, overnight had a big pop, about 16%. But it had quite a weak spell up until that point. And it's just about getting, making investors comfortable that growth is still going gangbusters, and 50% growth in its headline revenue is pretty gangbuster stuff. But you have to look below the numbers with a lot of these companies, and you see valuations are pretty eye-popping. 149, I think, is the PE, and that's on non-GAAP reporting standards. It still makes losses on GAAP reporting numbers. So investors really do need to take a close look at the figures rather than just get away from the reported numbers. But the one we mentioned last week as well was AI infrastructure, Databricks. They provide a lot of software into data centers, and we all know capacity in data centers is just undersupplied. So that they also had a big pop yesterday during the New York session. Jumped about 15% themselves. So there's plenty of good news around. It can seem like it's very negative, but I think we were chatting previously, weren't we, about the number of positive surprises in this earnings season has significantly outweighed the negative surprises.
Yeah, it has, and this AI theme is very divisive. Obviously, there are a lot of companies that are seen as being victims. I noticed today St James's Place is down 12% because you've got fears now that AI is going to infect the wealth management sector. So a lot of European wealth management firms down, St James's Place down. But Alphabet is getting away a 100-year bond
Yeah,
100 years.
absolutely. Yeah, that's a bit gobsmack, isn't it? It's a rare event. It's not the first time a company has issued a century-long bond, but of course, it's not really aimed at a retail market. It's aimed at insurers and pension companies who have these long liabilities. So they want really long duration fixed income assets to play that off against. But they are it's a much bigger fundraising call. They tried to raise $15 billion in the US recently, massively oversubscribed. They ended up raising 20 billion. This UK sterling fundraise is so far looks like it's been massively oversubscribed, and also doing money in Switzerland with Swiss francs. And this is really a case, I think, of Alphabet just spreading its credit risk around the world. And allowing all sorts of investors to get involved. So they will be issuing shorter duration corporate bonds, 1, 2, 3 years, possibly 10 years maybe. So something for retail investors to think about in that old kind of term about 60-40. You have 60% in fixed income assets and 40% in equity. Maybe that can be part of the corporate bond exposure.
Yeah, and I'm putting out a note on later this week on investing in bonds. If you want to, what is a bond? Why should you own them? How can it help your portfolio, and so on. So look out for that in the education section on the website. And
just to wrap up, you also wrote a short piece recently, Ian, on just reducing risk in a portfolio. So that went live a few days ago, didn't it? What were the key points?
Well, I think the key point is at the moment we're seeing increasing volatility in markets, and people might want to just trim their sails a bit, reduce their risk exposure. So we've just run through 3 really easy ways that you can do that. And again, go to the education section on the website, Sharesify.
Yeah, absolutely. Okay, well, that's about a wrap then from us for this podcast. As usual, if you want to get in touch with us, drop us a line at editorial@sharesify.com. If you're a company or fund or trust and want to get involved in these podcasts, that's the way to do it. If you're watching this on our direct on our YouTube channel, click the subscribe button, and we'll build our following there. And join us again, likely on Friday. We'll have an end of week wrap. So thanks, James. Thanks, Ian. And see you all next time.
Steve. See you soon.